You're welcome. Can you hear me? How is my audio? Can you see my screen? If you can see my screen, let me know. If I'm good to go, let me know. Yeah, you're welcome. If you can hear me, let me know. If you can see my screen, let me know. Okay, okay, okay. That's nice. All right. You're welcome. Good evening, everyone. Um, this is the voice of Dr. Richard, and currently live speaking to you from my trading station. And I wish you a happy Sunday and welcome to the new week. This week is filled with a lot of opportunities for us, as we can see on the financial markets calendar already. The Forex Factory calendar, we have good opportunities for us to actually benefit from. So, um, this week we have producers producers price index. We have producers price index, and we have CPI, which is consumer price index, coming out. So we also have the unemployment claims. Unemployment claims is being released 4 times in a month. You know, 4 times in a month. So this unemployment claim is the data that was received last week, right? First week of September. So um, this one that happened here on the 4th of September was the one that was gotten for the last week of August. So the unemployment claims comes out 4 times. You can see for August we had one, two, uh, three because of the week. Then July we had, okay, yeah, one, two, three, four for August. July, one, two, three, four for July. So we are going to have a total of four unemployment claims news release for this month. Then the consumer sentiment. Now, we need to understand that this production producers price index consumer price index, unemployment claims, and consumer sentiment. This week is basically about inflation. Is talking about how inflation is in the market, whether we are having uh, high prices of goods and services, just like we have here. If you look at this place, you see that the inflation rate right now in the US is 2.7%, right? 2.7%. So US annual inflation rate remained at 2.7% in July, all right? The same as in June, with the forecast below the forecast of 2.8. You understand? So it is what indicates whether your the price of egg in the market, the price of beans in the market, services, whether we are having higher prices or we are having lower prices. You get? That's what the uh, the PPI and the CPI is talking about. Then the unemployment claims, obviously, people who filed for unemployment, like people who are jobless in the last past week, people who are jobless. That's the figure that we are going to also get about. We are going to be getting it this week. That's on Thursday. Then on Friday we have consumer sentiment. This consumer sentiment is more like people's confidence in the economy. So if the economy is doing well or bad, the sentiment that is being gotten, that is the data that is being gotten by this university, University of Michigan. I hope you can see my screen very well. Okay, it's at 100. You can see my screen very well, right? I hope you can see my screen very well. So this University of Michigan, they are the people that collect this data for the trust people have in the economy. All right. So the consumer sentiment is data released for the days apart. Uh, the preliminary release is earlier and Thursday. Okay. Financial confidence is a leading indicator. When you have good, when you have this data, it indicates the financial confidence of both consumers and businesses in the economy. So you see, survey of about 420 consumers, which asked respondents to rate the relative level of current and future economic conditions. So this is just for the US economy. Now, the reason why um, we are just talking about the US economy is because we trade the US dollar, right? We trade the DXY, is the DXY that we trade. And then because we are tracking this, we are trying to understand fundamentally what this market is going to be giving us this week. So coming to PPI, the previous the previous data that came out was around 0.9%, which came out positive. That is production uh, production index, production price index. That's people who are into production. There was more like a positive data that came out for them. Okay, so you see here, actual greater than forecast is good for currency. So on the 14th, when this data was released, that is second week of August, the data actually came out positive. You see that the previous months have just been negative, right? So, but right now, because of the economic factor in the US right now, we are not really expecting much positive news from that, because if you look at this manufacturing PMI, this manufacturing PMI has been going down. It has been going down like I told us on my inner circle, I told them the last um the last meeting that we had, I told them that once we have 50.0, we have 50.0 as the indicator, which means that 50.0 is 50.0 upwards, means that the manufacturing plants, factories, and all that are actually doing well. But from this PMI news that was released last week, we had a negative news. So because of the negative news, I'm not very confident that we are going to be seeing an increase percentage for this producers price index. All right. Now, same thing goes with this core producers price index month on month, PPI month on month, then CPI month on month. This CPI is for consumers, while the PPI is for producers. So, like I said before, this indicates the inflation level in the US economy. This indicates the inflation level in the US economy, unemployment claims, and then the consumer sentiment. So this is what we are going to be having. So coming in into the week, we'll have inflation, just like we said. The spotlight will be on August key inflation data for updates on how you know the economic policy here have impacted in prices, and then consumer uh, the consumer inflation is expected to be at 2.9, which is the highest, which is the highest since January. So it means that things are going high, things are actually going, climbing higher in the US. Now, for the producers price index, we are expecting a 0.3. 0.3 is unchanged, because if you look at the previous month, it's the previous data that came out was 0.3. Sorry, the previous data that came out is 0.9. So we are actually forecasting, economists are forecasting 0.3, which is not good, because I told us that on the manufacturing PMI data that we had about 48.7. We had about 48.7 um, data points coming out. So, because we have this figure that was very low, we are anticipating that we are still going to have a low percentage figure for the producers price index, which is um, this from the previous month. Why rate cut? Because everybody, we are anticipating rate cuts in this September to fully take effect, because right now the inflation is going high, economy is not doing well, and a lot of things are going down. Now, that's for the fundamental aspect. In the technicals, we are looking at US dollar. We can see that the markets have been selling since we entered 2025. Since we entered 2025, the market has been going down. We've been having series of lower lows and lower highs, right? So I am anticipating, previous week candle closed bearish. Now, if you look at this, you'll see that we have we have this low, we have this high, we have this low, and we have this high. That have not taken out of this week. I've not taken out this high too. So I'm anticipating, what I am actually looking at is a this low needs to be retested on the longer on the longer term, on longer view. This market needs to be taken out. This low right here needs to be taken out because we are having CPI and every data, every indication from the market is pointing towards a negative data. So because we are going to be having a negative data, I am very, very bearish on the dollar. Previous week closed bearish, and looking at the daily time frame, you see that the market has been giving us series of lower highs here, and then these lows have been taken out. So I am anticipating on the dollar that we are going to test this 97.97 area. We are going to test this 97.97 area. Then we now finally come to 96.36 area. That's what I am anticipating. That's what I am anticipating on the dollar. So I'm still very, very bearish on the dollar. Previous day candle closed bearish. Let's see on the 4 hours. So on the 4 hour time frame, let me clear this. So on the 4 hour, we had this high and we have this low that is taking out this low. All right. So I'm anticipating that we have a pullback, then a continuation. So maybe Monday, Tuesday we have a peak, then Wednesday, Thursday we drop it downwards. That's what I'll be anticipating. On the H1, we can see that on the H1, the market broke below this low. So taking out that low, we need to see a retracement. This is a break of structure. We need to see a retracement to the top side. So possibly the market this, could use this, or the market to give us a deeper retracement into this zone for us to have uh, the sells. So we are anticipating buy from Monday to Tuesday. Then on Tuesday, Wednesday, Thursday, Friday, we'll see a breakdown. Possibly on the Wednesday, we are going to have high of the week. Why? Because of this CPI news that is coming out. You see, on Monday and on Tuesday, we do not have any news. There is no news coming out on Monday and Tuesday. So on Wednesday, Thursday, Friday, that's where we have our major news coming out. So I'm expecting that we'll have a rally to the upside. Then Wednesday giving us the high of the week will now send the market downwards. So if we are having that, it means that we are going to have some sort of retracement on gold. Already we have this break of structure here, which is our BOS. Or let me even start from the weekly. Let's start from the weekly time frame. Good. So you see from the weekly time frame, this market has finally distributed from this point that was used as a support level to this point that is the external range liquidity. So we have a break of that level, which is break of structure. And then we having a break of structure, what do we have? We have a fair value gap here. So going down, refining to the lower time frame, we already have a retested fair value gap here. Let me put this. So we have this retested fair value gap here, this one, and the market used it as a support level. Going down to the H4, we see that they grabbed liquidity from these lows, tapped into this imbalance, and then gave us a break of structure. Giving us this break of structure, we had a fair value gap here. So because I'm bearish on the dollar, I'm anticipating that this market will go up further. In fact, I am looking at 650. The last analysis we had was I was looking at 600. So I'm looking at a psychological figure of 650. That is 3,650. 3,650 as my next target. So there is tendency that we'll have a push into this, then we go higher because of this break of structure that we have. And we can see that market structure on gold is actually giving us a higher highs and a higher lows. Right, the market structure on gold is giving us higher highs and higher lows. All right, so we're anticipating another higher low to give us another higher high. So that is what I'm anticipating for the technical. So we have done the fundamentals, we have done the technicals. Let's talk about risk management. One thing that will keep you in this market is when you understand risk management. When you really apply risk management, not just understanding it, because you don't necessarily need to understand risk management at a full scale for you to apply it. It's just common sense. All right. If you have $1,000, don't risk over 1 to 2% of your account. Don't risk over 1 to 2% of your account. Already, if you have $1,000, because you have $1,000, 10% of that $1,000 is already at 100. So for you to do 1%, it means that you are risking $10. All right. So if you risk $10 of your 1,000, it means that what you are having, if you risk $10 and you say this market came out negative, all right, it means that you still have $990 to trade with. And this gives you more chances to look for your A plus setup, because you can't just go into the market and start taking random trades like that. No, you have to look for your A plus setup. So because you are risking just 1%, sorry for the background noise. I'm living in very close to the airport, so we might be getting this noise time to time. All right. So back to what I was saying. Because you are risking 1% of your $1,000. All right. Because you are risking 1% of your 1,000, which is $10. you still have $990 to trade from while you are looking for your A plus setup. While you are looking for your A plus setup. So it means that out of this, you can try these 100 trades. So you have to lose 100 trades for your $1,000 account to go entirely, while you are risking just $10. You can even risk $5. It's possible that you can risk $5. All right. Now, you need to understand something. Not all trades will go your way. Even most of your A plus setups, they might not go your way. Most of your A plus setups might not go your way. Why? Because you can be on a trade. Let's say right now we are at premium. All right. And you know that buying from premium is very risky. So it means that at premium level, they can reverse this market, taking out previous lows. All right. So because you are risking $10, if the market should reverse on you, it means that you are not losing a lot. You are going to wait for the market to do what? Retrace. You enter the market, your entry, your stop loss, and you do what? Anticipate that the market will go in your favor. Now, your risk to reward would have made you to regain the loss that you had plus profit. Plus profit. So that is why it is very, very important to apply risk management. Risk management will save you in the market. And a lot of us have not really been giving our accounts the respect that it needs. You need to understand that the money that you have right now is not your own. All right? It's God's money. You need to come you need to come to realization that whatever it is that is being given to you is just for you to manage. You're a manager. So when you are managing something that is being given to you, you treat it with utmost respect. A lot of us don't treat our accounts with respect. We just come into the market, do things at random, and you feel like you are going to get a definite result. No, you are going to still get random results because you are doing random things. You are going to get random results because you are doing random things. So your risk management should be intact. If you are risking $10, some of the risk management strategies that you can apply, you can risk via dollar. That is a certain amount of dollar that you want to risk in the market, or via percentage, you want to risk a certain amount of percentage in the market, let's say 0.5% or 1% or 0.8% or 2%. Don't go above 2%. Don't go above 2%. Going above 2%, it means that you are putting your account into a very, very, very wrong and bad situation. Because if anything should happen, it will mess up your psychology, and then before you know it, you start trading in a way that you are not supposed to trade. Now you need to understand something. Your trading edge is not your strategy. Your trading edge is not your strategy. Your trading edge is you, the trader. You, the trader, is the trading edge, not your strategy. Strategy is just strategy. But for you to have a complete edge over the market, it means that you need to come clean. You need to come correct. So you are the edge. So if the edge is broken, definitely is going to reflect on the results. Is going to reflect on the results. So your risk management is something that you need to treat with utmost priority. All right, you are going to treat it with utmost priority. If the market takes you out, let's say you are trading on a Monday or in a Tuesday, whatever day it is, you are, and the market takes you out two consecutive times, just allow the market to rest, allow the market to breathe, because you don't know what the market is trying to do. You don't know what the market is. You don't understand the data at that point in time, so you just leave the market. Okay, you just leave the market. That alone will save your account on the long run. That alone will save your account on the long run. So our trading plan going into next week, we are not expecting volatility on Monday. We are not expecting any volatility on Tuesday, but we are expecting volatility on Wednesday, Thursday, Friday. So it does mean that Wednesday, Thursday, and Friday are actually good days for us to trade. All right, they are days with high probability liquidity setups. And then if you are looking at the markets within these days, you are going to get more um, liquidity run to either your take profit or your SL on Wednesday, Thursday, Friday. So Monday and Tuesday we'll just watch the market and see what the market is going to do. That's our trading plan. Then the entry and exit levels. Our entry and exit strategy, we already know. Um, we use two ways. You either use your order block, your fair value gap, or you use your OTE, right? Or we use the OTE. So the OTE gives us a precise entry. Now that we have this break of structure here, we are anticipating that this market will do what? Will come into this level, give us a break, then we'll go higher. That's what we'll be anticipating. So you can use the order block, you can use the breaker block, and you can use the OTE. All right. So for most of us who don't really understand how to build a trading plan, let me show you guys how my trading plan looks like. So this is what my trading plan looks like. I stick to the trend. Structure and liquidity is what I trade. SLT, structure, liquidity, and timing. And I trade basically gold. And my playbook is 2022 model. Then my risk management is 0.5%, and my loss per week, I lose only 1%. I tend to lose only 1%, and my risk to reward is 1 to 2 R. Then my weekly targets, I look at 2% on. Then trading days, Monday, Tuesday, Wednesday, and Thursday. Fridays, I just rest. And trading time, London Q zone and New York Q zone. That's what I trade. Then how many losses per day? One. How many wins per day? Two. Max. Two maximum. So then these other things are stuff I wrote out for myself that I look into. All right. So that's how you can be able to create your own trading plan. So you need to have a very good trading plan so that whenever you are entering the market, you are entering with strategy, you are entering with precision. You are not coming into the market to do guesswork. All right. You're not coming into the market to do guesswork. And then you need to understand that whatever trade that you take at the end of the day and it takes you out, that's not the end. You are not going to define yourself as a trader via one trade, with just one trade. You will not, you will not do that, right? You need to trade over a series of trades, at least your first 10 trades. Your first 10 trades, you take that, you understand what you are missing out, what you are getting right, you repeat it. If you are getting something right, you repeat it. If you are getting something right, you repeat that thing. If you are not, remove it and find something that works well for you. All right. When you are able to find something that works well for you, you can be able to maximize it and scale and scale. So thank you for joining. So do you have any question? Do you have any question to ask? All right, all right. Thank you for joining. On Monday I have my section with my inner circle, and please, if you want to join the community, just type in forexempire dot card.co. You'll be able to join the community through this. These are our websites. You just click here, it will take you to where you can be able to join the community. We have good products that you can actually benefit from. This is 60 days to profitability, how you can be profitable in 60 days. Then we have this crash course, is our bestseller anyway. If you are somebody that wants to come into the forex industry, you don't know anything about forex, from the basics, we made it detailed for you. We made it very detailed for you so that you'll be able to understand all the jargons that is being um that people, a lot of people talk about on the forex market, from your leverage to your pips to your free margin to your equity, all those things. We made out a video, even pips, how to calculate your pips and all that. Then we have a simple SMC criteria. This book is also good for many traders. If you are looking at joining, looking for a very good entry strategy to use, that book is very good. Then, if you want our mentorship, if you want our mentorship, we have the exclusive mentorship and we have the regular mentorship. So to join our free community, you click on the free community link. You just click here, get now, and then you join the community. Then for beginners, also this goes hand in hand with this, but we had to make the book to be very free. You can get the book. We have we made everything very easy. What you'll be able to learn: candlesticks, support and resistance, risk management that I spoke about today, and everything in the book is just very explanatory. So make sure that you click the this link to join the community, and I will see you on the next one. Thank you all for joining. I would see you on the inside. Bye.